Every time I hear a Goldbug telling someone that they use physical gold as an alternative to a savings account at a bank, I cringe. These Goldbugs will tell you that physical gold coins or other bullion are a better alternative to keeping your savings in a bank account for two reasons. One, you'll save longer than you would with cash because it's more difficult to spend your money since you'd need to sell the gold to a dealer to convert it back to cash. Two, gold protects the value of your money over time as a hedge against inflation. When a country's fiat currency devalues over time, gold increases in price against that currency. While those are both valid reasons to buy physical gold, you can make a huge financial mistake blindly following their advice without taking two important questions into account. Number one, what's your time horizon? How soon might you need access to your savings? Number two, what's your cost basis on that gold bullion that you purchased? Volatility over time. While gold's spot price, the cost per ounce of gold, historically increases over time in relation to inflation, the gold market is surprisingly volatile and can sell off dramatically. Additionally, gold can and does spend years and even decades trading within a range. If you think you might need your savings for a big purchase or an unexpected expense sometime soon, buying gold may expose you to potentially devastating financial losses on your savings. For example, if you bought gold back at its high in September 2011, it is currently trading at roughly the exact same price in September 2023, 12 years later, and you may not have even broken even yet. Of course, there were opportunities to buy gold at much lower prices over that time period. Gold sold off from its high in September 2011 to a low of $1,046 per ounce in December 2015. This means that someone who saved with gold in September saw the value of their savings get cut by 45% over 4 years. In fact, if you had bought at gold's highs in 2011, your savings wouldn't be worth what they were until June 2020. In other words, you would have lost savings if you sold any time before June 2020, nearly 9 years later. Because of gold's huge price swings, many gold buyers will either dollar cost average or buy gold in stages rather than going all in. There's no way of knowing when gold may sell off or rally, and you certainly don't want your savings to drop 45% in value. As a result, if you choose to save with physical gold or even paper gold, you need to make sure you won't need your savings for years, if not decades. If you think you might need your savings sooner, you'd be much better served in a savings account where your savings would generate interest, currently as high as 4.5%. Cost basis. You must remember that very few people can buy gold for its spot price. If you buy from a dealer, you must pay a premium, a cost above that spot price. This premium can range between 4 to 30% over spot, depending on gold's popularity at the time, the size or denomination you buy, and even what payment type you use, with credit card payments often adding 3 to 4% or more to the base premium. To make matters worse, if you buy anything less than a full ounce of gold at a time, the premium increases dramatically. The premium cost on the smallest American gold eagle, 1/10 of an ounce, is currently 18% over spot versus the 5.19% over spot a 1 ounce gold coin costs. Since many people don't have the ability to shell out $2,000 or more every time they want to save, this can result in a premium of nearly 20%. While it's true that you receive a premium over spot when you sell gold coins back to dealers, it's much less than what you paid when you bought it. For example, JM Bullion, a popular online dealer, will pay you 2.3% over spot to sell them a 1 ounce 2023 American Eagle. However, they charge 7.28% over spot when you buy one, which is a 4.98% difference. What this means is in order for your savings to break even, you need the spot price of gold to increase about 5% over where you bought it, the difference in the spread of the premium. In other words, with gold currently trading at $1,938 an ounce, anyone who bought in the last 6 months is down on their savings. And that's just for 1 ounce American Eagles. For the smallest 1/10 of an ounce American Eagle, the premium to buy a coin from JM Bullion is currently an astounding 52.45%, and the premium to sell to them is 7.69%. This means you need gold spot price to increase an astounding 44.76% higher than where you bought it, just to break even. Anyone who bought 1/10 of an ounce American Eagles when gold was $1,347 or higher is underwater right now. Gold hasn't been that cheap since June 2019, more than 4 years ago. This is why when tracking your gold purchases, you must account for the full price you paid for your physical bullion, not just the spot price. Many gold bugs, whether intentional or accidental, don't account for the premium they paid when they talk about their savings. So if the spot price is higher than when they bought their gold, they will make the mistake of thinking their savings have increased in value. However, if the spot price hasn't increased by the premium spread from where they bought to where they can sell, they might not even be at break even if gold has increased substantially from where they bought it. Time horizon. With gold spot price currently $1,940, if you had purchased a 1-ounce American Eagle at $1,862 or more any time in the last 6 months, you'd still be at a loss as the price per ounce hasn't increased beyond that 4% premium. And even if you were at break even, many online banks offer interest rates of 4.5% or more, meaning your $1,940 would be worth $1,984 if you just kept it in a savings account over the same 6 months instead of keeping it as gold. Over 6 months, you missed out on earning $44 in interest on your savings because gold offers no yield, and the losses are greater if you weren't able to buy at that 4% premium. If you're saving with gold and need cash suddenly due to an unexpected expense, you can easily be in a situation where you'll lose money, sometimes a lot of money. What if you need to sell when gold is in a downtrend, or if you haven't seen the spot price increase enough to account for your premium cost? When to buy physical gold. All of this isn't to say you should never buy physical gold. Personally, I look at physical bullion as an alternative investment with no counterparty risk. In other words, I physically hold that investment, so I don't need the stock market to be open to access my asset. However, physical gold is not savings to me. In fact, I never plan to sell any of my gold. I plan to pass it down to my family when I die, or use it for an incredible opportunity in the event that fiat currency gets devalued to such an extent that my gold offers me better investment opportunities than keeping it as physical gold. Gold can be an excellent hedge against inflation and geopolitical strife, but you need to have an incredibly long time horizon of at least 5 years, and preferably longer, in order for gold to consistently work as it has over thousands of years. How to save in gold. If you still want to keep some of your savings in gold, consider buying paper gold through the stock market. By buying a gold ETF like GLD or IAU, or by buying the Sprott Physical Gold Trust, PHYS, you get the same exposure to the spot price of gold, except now you aren't paying any premium to buy or sell your gold exposure. Many gold bugs, myself included, don't believe the ETFs are an alternative to the physical metal if you want to use gold as a hedge against inflation. Even the Sprott Physical Gold Trust, which buys gold dollar for dollar to match the trust, still requires access to your brokerage account in order to buy or sell it. However, if you're looking at using gold as an alternative savings account, using the ETFs and Sprott Trust give you the same exposure but remove the premium costs, providing a more affordable and less financially risky way to use gold as savings. Every investor should have a hedge against inflation in their portfolio, whether that's gold, Bitcoin, or real estate. But anyone considering using gold as an alternative to a savings account needs to know that doing so could have the opposite effect of what they're looking for, and that they could lose significant amounts of their savings.